Hey everyone, and welcome back. Today we're going to do a deep dive into a topic that's super important for any trader out there,
Absolutely.
especially as we head into 2024. We're talking stop losses.
Yeah,
It's fascinating to me how much emphasis is placed on this one little tool
it's true.
when it comes to managing risk and trading.
Ah.
And today we're going to break it all down based on this really cool YouTube video
Yeah.
by Riqueza Vital called "Riqueza in Stop Loss in Trading 2024. Como usar Stop Loss 2024."
I love that channel. They do such a great job of
I know.
visualizing these concepts,
Yeah, the visuals are awesome. It's like they made a comic book about finance.
Right.
So before we get too deep into the nitty-gritty, let's start with the basics. What exactly is a stop loss order?
Yeah. So in the most basic terms, a stop loss order is like this automatic safety net for your investments.
Okay, I like that.
It basically tells your broker to sell an asset when it hits a certain price that you determine beforehand. So you're essentially setting a limit on how much you're willing to lose on a particular trade.
Exactly. It's like saying, okay, if this investment starts going south, I'm only willing to lose this much and no more.
That makes a lot of sense. So it's all about protecting yourself from those big unexpected losses.
Exactly. And it can really help to take some of the emotion out of trading because you know you have that safety net in place.
Right, because when you're watching your investment tank, it's easy to panic and make irrational decisions.
Absolutely. Fear and greed can really cloud your judgment when you're in the heat of the moment. A stop loss can help you to stay disciplined and stick to your plan.
The video gives a really good example of this with a stock purchase. Can you walk us through that?
Sure. So let's say you buy a stock at $50 per share and you set your stop loss order at $45.
Okay.
If the price of the stock drops to $45, your broker will automatically sell your shares. This limits your potential loss to $5 per share, even if the stock continues to fall.
So even if the stock plummets to I don't know, $20, you're only out those initial $5 per share.
Exactly. You've effectively limited your downside risk.
That's pretty powerful when you think about it.
It is.
Because let's face it, not every trade is going to be a winner.
Definitely not. And no one can predict the market with 100% accuracy.
Right. So it's not about avoiding losses altogether.
No.
It's about managing them so they don't wipe you out.
It's about protecting your capital so you can stay in the game for the long haul.
I'm starting to see how this can be a real game changer for traders.
It is. And what's really interesting is that there are different types of stop loss orders.
Wait, really? I thought a stop loss was a stop loss.
Nope. There's actually a whole variety of them, each designed for different trading scenarios.
Okay. I'm intrigued. Tell me more about these different types.
Oh, we have the standard stop loss event, or self-stop loss, which is the one we just talked about with the stock example. It's used when you're buying an asset and you want to protect yourself from a price drop.
Okay, so that's the classic buy low, sell high scenario.
Exactly. But then we have the stop loss de compra, or buy stop loss, which is used when you're shorting an asset.
Ah, shorting. That always seems kind of mysterious to me.
It can be a bit more complex, but essentially you're betting on the price of an asset going down.
Got it. So with a buy stop loss, you're protecting yourself if the price goes up instead of down.
Precisely. You're limiting your losses if your short position moves against you.
So it's kind of like a reverse stop loss.
Exactly. It's all about managing risk no matter which direction the market is moving.
I'm starting to see the nuances here. What other types are there?
Then we have the stop loss dynamico, or trailing stop loss, which is like a dynamic safety net that adjusts itself as the price of the asset moves.
Okay, now that sounds really interesting. How does that work?
So imagine you buy that same stock at $50,
Okay,
but instead of setting a fixed stop loss at $45,
right.
you set a trailing stop loss at, let's say, 10% below the market price. As the stock price goes up, your trailing stop loss will automatically adjust upwards, always staying 10% behind the current price. So if the stock climbs to $60, your trailing stop loss would move up to $54.
So it's like the stop loss is following the price as it goes up, locking in those gains along the way.
Exactly. And if the price suddenly reverses, you're guaranteed to exit the trade with at least a $4 profit per share.
That's pretty clever.
It is. It's a great way to ride an upward trend while still protecting yourself from a sudden downturn.
It's like having your cake and eating it too.
Kind of. But of course, you always need to be mindful of the risks involved in any trading strategy. No strategy is foolproof.
Right. It's all about managing risk and finding what works best for your individual trading style and risk tolerance.
Exactly. And then there's one more type of stop loss I want to mention. The stop loss garantizado, or guaranteed stop loss.
Okay. This sounds intriguing.
It's like the ultimate peace of mind stop loss because it guarantees that your position will be closed at the exact price you set, no matter what happens in the market.
So even if there's like a flash crash or some crazy volatility, you're still protected.
Exactly. It takes the guesswork out of stop losses.
So is this like the holy grail of stock losses then?
It can be a great tool for traders who value certainty and want to avoid the risk of slippage, which is when your order gets filled at a different price than you expected due to market volatility. But it typically comes with a slightly higher cost.
So it's like an insurance premium for your trade. You're paying for that extra peace of mind.
Precisely. But for some traders, that peace of mind is worth the cost, especially when dealing with volatile markets or large positions.
Yeah, I can see that. Okay, so we've covered the different types of stop loss orders,
Uh,
and I'm already starting to see how much more strategic this is
yeah.
than I initially thought. But now I'm curious about the actual process of setting those stop loss levels. Like, how do you decide where to place that stop loss? Is it just a random number?
It's definitely not random. There's a lot of strategy involved, and Riqueza Vital really breaks it down in their video. One of the most important factors to consider is market volatility.
Okay, so that makes sense. If the price of an asset is jumping all over the place,
Right.
you need to give it a wider berth.
Exactly. If you set your stop loss too tight on a volatile asset, you risk it being triggered by normal price fluctuations, even if the overall trend is in your favor.
So it's kind of like giving your trade some breathing room to ride out those waves.
That's like that analogy.
What else do we need to consider when setting our stop losses?
Your trading style is a big one. Are you a long-term investor who's comfortable holding positions for months or even years?
Right.
Or are you a more active trader who's constantly making short-term moves?
I tend to fall more into that second category.
So as an active trader, you'd probably want to use tighter stop losses to react more quickly to market changes. Whereas a long-term investor might be comfortable with a wider stop loss because they're not as concerned with those short-term fluctuations.
So it's all about tailoring your approach to your specific trading style.
Absolutely. It's not a one-size-fits-all kind of thing.
Okay, that makes sense. Now, what about position size? Does that play a role in where we set our stop losses?
Absolutely. Think about it this way. If you have a large position,
Right.
a tight stop loss could wipe out a significant chunk of your capital
Ouch.
if it gets triggered.
Yeah, that's not a good feeling.
On the other hand, a wide stop loss on a small position might not be effective enough to protect your profits. It's all about finding that balance between risk and reward.
This is making me realize how much thought and strategy goes into using stop losses effectively.
Yeah, it's more than just setting a random number and hoping to the best.
It's about understanding the dynamics of the market, your own risk tolerance, and tailoring your approach to fit those specific parameters.
Exactly. And one more thing I want to emphasize is that continuous learning is crucial in trading.
Couldn't agree more.
The market is constantly evolving, so staying updated on best practices and new techniques is essential.
So it's like any skill,
Yeah.
you got to keep honing it.
You got it. Don't be afraid to utilize the resources that are available to you, whether it's from your broker, online communities, or educational platforms.
That's great advice. Okay, so we've talked about the benefits of using stop losses,
Mhm.
but now I'm curious about the flip side. What are the potential pitfalls of not using a stop loss? What kind of risks are we exposing ourselves to if we ignore this tool?
The video really hammers home this point about how markets can move so rapidly,
Yeah.
it becomes nearly impossible to react manually in time to prevent a significant loss.
So it's like trying to catch a falling knife.
It can be.
You're bound to get cut.
Exactly. Without a stop loss, you're basically relying on your ability to perfectly time your exits every single time, and that's just not realistic. Even the most seasoned traders get it wrong sometimes.
So having a stop loss in place is like having an insurance policy for your trades.
I like that analogy. It provides a safety net that can help you to sleep better at night, knowing that you're protected, at least to some extent, from those unexpected market swings.
Okay, so we've covered why stop losses are important, but I'm also curious about the mistakes that people make when using them. What are some of the common pitfalls we should be aware of?
One of the biggest mistakes I see traders make is setting their stop losses too close to the current market price.
Okay, so you're saying like if a stock is trading at $50,
Yes,
don't set your stop loss at $49.99.
exactly. It's tempting to do that because you want to maximize your potential profit.
Right.
But even a small fluctuation can trigger the stop loss and take you out of the trade prematurely.
It's like you're not giving the trade enough room to breathe.
Exactly. And then you miss out on potential gains if the price moves in your favor.
So how do you find that sweet spot?
It's a balance between protecting your capital
Hmm.
and giving your trade enough space to work. It really depends on the volatility of the asset, your own risk tolerance, and the specific parameters of your trading plan.
So again, it's not a one-size-fits-all approach.
Nope. It requires careful consideration and adjustment based on the unique circumstances of each trade.
Okay, that makes sense. What other mistakes do people tend to make with stop losses?
Another common one is neglecting to factor in asset volatility, which we touched on earlier. Remember, different assets have different personalities. Some are like roller coasters with wild price swings, while others are more like a gentle stroll in the park.
So you're saying we can't use the same stop loss strategy for every trade?
Exactly. You need to adjust your stop loss distance based on how long the price of that particular asset tends to jump around. A wider stop loss for a more volatile asset and a tighter one for a more stable asset.
This is making me realize there's a real art to using stop losses effectively.
It's definitely both an art and a science.
Hmm.
It requires understanding the nuances of the market, your own risk tolerance, and the psychological aspects of trading.
Speaking of psychology,
Yes.
I think we need to dive into that a little bit more.
Okay.
Because I have a feeling our emotions play a huge role in how we use and manage stop losses.
Oh, absolutely. Our emotions can be our biggest asset or our worst enemy in trading.
So let's unpack that in the next part of our deep dive. We'll be right back after a quick break to explore the fascinating world of trading psychology and how it intertwines with the effective use of stop losses.
Welcome back to the deep dive. So we've been talking about stop losses.
Yes,
And how important they are for managing risk.
absolutely.
But I think it's time to address the elephant in the room,
Okay.
our emotions.
Yes.
Because let's be honest, trading can be an emotional roller coaster.
Oh, it definitely can. Our emotions can really influence our decisions.
Yeah, sometimes it feels like I'm making decisions based on fear or greed rather than logic.
It's a common struggle for traders. One of the most common emotions that can trip us up is fear.
Oh, fear for sure. Fear of
Yeah.
missing out, fear of losses.
Exactly. And that fear can lead to all sorts of bad decisions, like selling too early or not buying in at all.
Yeah, I've definitely been there. Like you see a stock starting to take off and you're so afraid of missing out that you jump in at the worst possible time.
It's a classic case of FOMO, fear of missing out. Exactly. And then you end up buying at the top of the market.
Right. And then when the price starts to drop, you panic and sell at a loss.
Yeah, that's happened to me more times than I care to admit.
It happens to the best of us. The key is to recognize those feelings of fear and to not let them control your decisions.
So how do we do that? How do we overcome those fears?
Well, one of the best ways to combat fear in trading is to have a solid trading plan.
Okay, so that's like having a roadmap before you set out on a journey.
Exactly. Your trading plan should outline your entry and exit points, your risk management strategy, and your overall goals for trading.
So when those fears start creeping in, you can refer back to your plan and stay on track.
Exactly. It's like having a set of rules to follow so you're not making decisions based on emotion in the heat of the moment.
That makes a lot of sense. But fear isn't the only emotion that can get us into trouble, right?
Definitely not.
Yeah.
Greed can be just as dangerous.
Oh, yeah. Greed is a powerful force.
It can be. It's that desire for more, more, more.
You see those profits rolling in, and you just want to keep pushing it further and further.
I know the feeling. But greed can lead to holding on to trades for too long and watching those profits disappear when the market turns against you.
It's like that old saying, bulls make money, bears make money, pigs get slaughtered.
Exactly. Greed can turn us into those pigs if we're not careful.
So how do we avoid that? How do we tame that greedy monster?
One way is to set realistic profit targets before entering a trade.
So you're basically deciding ahead of time how much profit you're happy with.
Exactly. And when you hit that target, you take your profits and move on.
Don't get greedy and try to squeeze every last penny out of the trade.
Exactly. Remember that there will always be other opportunities in the market.
Right. There's no need to risk your hard-earned profits by being too greedy.
And this is where stop losses can be really helpful in managing those emotions.
Okay, how so?
Because a stop loss can act as a safety net that takes the emotion out of the decision-making process.
So you're not constantly second-guessing yourself or getting swayed by those feelings of fear and greed.
Exactly. You've already predetermined your exit point, so you can just let the trade play out according to your plan.
That makes a lot of sense. Okay, so we talked about fear and greed,
Mm-hmm.
but are there any other emotional traps that traders tend to fall into?
One that I see a lot is the tendency to become emotionally attached to our trades.
Oh, tell me about it. It's like you fall in love with an idea and you refuse to let it go even when the market is telling you you're wrong.
It happens all the time. We get so invested in our trades that we start to see them as a reflection of our own intelligence or our trading skills.
Yeah, it's like our ego gets wrapped up in the trade.
Right. And when the trade starts going against us, we take it personally.
Like we're somehow a failure if the trade doesn't work out.
Exactly. But the market doesn't care about our egos.
Right. It's just doing its own thing.
Exactly. So we need to learn to detach ourselves from those emotional attachments.
So how do we do that? How do we let go of that ego and trade more objectively?
One way is to focus on the process rather than the outcome.
Okay, I'm listening.
Instead of obsessing over whether you're going to win or lose, focus on executing your trading plan with discipline and precision.
So it's about following the rules and not getting caught up in the emotional ups and downs.
Exactly. Because ultimately, you can't control the market. You can only control your own actions.
Right, and that's where stop losses come in again, right?
Absolutely. Because a stop loss can help you to stick to your plan and avoid making those emotional decisions that can lead to bigger losses.
It's like having that safety net in place so you can let go of the need to be right all the time.
Precisely. And that can be incredibly freeing for traders because it takes a lot of the pressure off.
Yeah, I can imagine. It's like you're giving yourself permission to be wrong sometimes,
Exactly. Because no one is right all the time,
especially in trading.
especially in trading.
So what other advice do you have for managing our emotions in trading?
One thing that's really helped me is to practice what I call mental rehearsal.
Okay, mental rehearsal.
Yeah.
What's that?
It's basically visualizing different trading scenarios before they happen.
So like imagining the price going up, imagining it going down.
Exactly. And imagining yourself reacting calmly and rationally in both situations.
So you're mentally preparing yourself for the inevitable ups and downs of the market?
Precisely. Because when you've already visualized those scenarios in your mind, you're less likely to panic or make impulsive decisions when they actually happen.
That's a really interesting technique. It's like training your mind to stay disciplined even when things get crazy.
Exactly. And another important tip is to learn from your mistakes.
Okay, so if a trade goes bad, don't just brush it under the rug.
Right. Analyze what happened, identify what you could have done differently, and use that knowledge to improve your trading in the future.
So it's all about continuous learning and improvement.
Exactly. Trading is a journey, not a destination.
This has been such a valuable discussion. I feel like I'm starting to understand the psychology of trading a lot better now.
I'm glad to hear that. Because understanding your own psychology is just as important as understanding the technical aspects of trading.
I couldn't agree more. Now, before we wrap up this part of our deep dive,
Okay.
I'm curious to hear more about how we can develop a stronger trading mindset that supports the effective use of stop losses.
That's a great question. And it's something that we can definitely explore further in the next part of our deep dive.
Welcome back to the deep dive. So we've been talking a lot about the mental game of trading
We have.
and how our emotions can sometimes sabotage our best laid plans,
It's so true.
especially when it comes to using stop losses. You know, I've been thinking about what you said about becoming emotionally attached to our trades.
Yeah.
And I think that's a big one for me.
It's a common trap for traders.
It is. Like, I get so focused on proving myself right
Right.
that I ignore all the warning signs that the market is sending me.
We've all been there.
It's like my ego gets in the way of my good judgment.
It's tough to separate our sense of self-worth from our trading results.
It is. So how do we overcome that? How do we detach ourselves from our trades and make decisions based on logic rather than emotion?
Well, one thing that can help is to remember that every trade is just one trade.
Yeah.
It's not the end of the world if it doesn't work out the way you hoped.
Easy to say, hard to do, though, Rob.
It is. But it's important to keep things in perspective. Don't let one bad trade ruin your entire day or week or even month.
Okay, so how do we actually do that? Like, how do we keep things in perspective when it feels like our hard-earned money is on the line?
One practical tip is to keep a trading journal.
Okay, a trading journal.
Yeah, where you track not just your trades,
Right.
but also your emotions.
Oh, interesting.
So after each trade, write down what you were feeling when you entered the trade,
Okay.
what you were feeling when you exited the trade,
Got it.
and any other thoughts or observations that come to mind.
So it's like a self-awareness tool.
Exactly.
Mm.
By tracking your emotions, you can start to see patterns in your behavior and identify those emotional triggers that might be leading you to make bad decisions.
I like that. So we're basically becoming more aware of our own psychology.
Right. And that awareness can help us to make better decisions in the future.
Now, what about that mental rehearsal technique you mentioned earlier? Can you tell us a little bit more about that?
Sure. Mental rehearsal is a powerful tool that athletes and performers have been using for years.
Right. I've heard of that.
And it can be just as effective for traders.
Okay.
Essentially, you're just visualizing yourself trading successfully.
So like picturing yourself entering trades at the right time,
Uh-huh.
exiting trades at the right time,
Yes.
managing your risk effectively.
Exactly. By repeatedly visualizing yourself trading successfully, you can train your mind to react calmly and confidently in real-life trading situations.
So it's like you're building muscle memory for your mind.
Exactly. You're creating those neural pathways that will help you to make better decisions when the pressure's on.
I like that. It's like we're rewiring our brains for trading success.
Kind of. And another important aspect of mental rehearsal is visualizing yourself, handling those inevitable losses gracefully.
Okay.
Because no matter how good you are, you're going to have losing trades.
It's part of the game.
It is. So by visualizing yourself, accepting those losses as part of the process, and moving on without letting them derail, you can build that mental resilience that you need to succeed in trading.
So it's about learning to bounce back from setbacks.
Exactly, because trading is a marathon, not a sprint.
And speaking of marathons, I think we've covered a lot of ground today in our deep dive into stop losses.
We have.
From the different types of stop loss orders to the psychology of trading and how to manage our emotions effectively.
It's been a great discussion.
I hope our listeners feel empowered to go out there and use this knowledge to improve their trading.
Me too.
Remember, trading is a journey and we're all in this together. Thanks for joining us on the deep dive.
See you next time.